What is up, guys? Welcome back to another video. My name is Nash, and in this video I'm going to be going over some formulas that you have to know, right? If you're going to go to business school, these are things that you're going to learn. If you run a business, these are things that you need to understand. While you don't really have to memorize these equations or know how to do them, because we do have software that allows us to calculate some of these things, so you don't have to do it. But it's also important to know what it's calculating, where the numbers are coming from, and what the end result actually means. So that's why I wanted to cover these. These are general business formulas that you're gonna find everywhere in business. Now, the first one is going to be the accounting equation. So this is the equation that makes up the balance sheet. Now, if you are looking at a balance sheet, you're going to see that the total assets are going to be on the left. They should equal the liabilities and equity, which is on the right. So that's why it's called a balance sheet, because they have to balance. Now, the next one is going to be the net income equation. Now, this is what's going to help you know if your business is profitable or not. Especially if you're looking for investors, they need to know if your business is actually making money or losing money. So the net income equation is going to be the revenues minus expenses. So the revenues is how much money you make, right? If you sell things, if you have services, all the money you make is the revenue. And you also have expenses, which is money coming out of the business. So when you take the revenue and you subtract the expenses, now you get a net income. So you're always going to have two results when you're calculating the net income. So you might have a positive net income, right? You're making money. Or you might have a net loss, which means you're not making money. Now, the next one is going to be the break-even point equation. So this is what's going to help your business know if they're going to be able to cover costs, or if they're going to, not have enough money to cover the costs or expenses, right? So the equation is essentially the sales that you make, right? This is money that's coming in, and you're going to subtract the fixed costs. These are things that you cannot really change, like rent. You have to pay that in order to operate your business. And minus variable costs, these are things that you can kind of like adjust. And all this is to try to generate a profit of zero. So when you go through this equation and you get zero as your profit, that means you're breaking even. So you're not losing money and you're not making money. Now, if your profit moves from zero to any number above zero, that means you're going past the break-even point and you're actually making a profit. If it goes below that, that means you're not making a profit, you're losing money. So the break-even point is really good if you try to project whether you're going to be able to break even. And when you're doing this, you might have the sales that you're expecting to get, and you can also calculate the fixed cost of running the business, right? And you can calculate the variable cost, and you can kind of like try to project if your business is going to be able to break even. So the next one is going to be the cash ratio equation. So when you run a business, you might you have some loans, you might have, a lot of debt. So this equation is going to help you kind of like determine how liquid your company is, or your ability to pay off all the debts if you had to. All right, so the first part of the equation is cash, right? So this is going to be how much actual cash you have, and also any cash equivalent investments that you might have. And it's going to help you if you have highly liquid cash investments, where it could be something that you can sell within a year, or as fast as you can sell it in order to convert it to cash. And the second part is going to be the current liabilities. So this is going to be how much you currently owe, right? Something that needs to be paid right away. I think it's like within a year. Now, the next one is going to be the profit margin equation. So this is going to tell you how well your business uses its revenues to generate a profit. So essentially, it reports the net income earned on each dollar of sales. So the equation is going to be the net income divided by the sales. So the net income is going to be the total money that you have minus expenses. That's how you get that net income number. So revenues minus expenses, you get your net income, right? It could be a profit or it could be a net loss. Now, the sales are going to be the operating revenue that you generate from the business itself. All right, so when looking at this equation, you always want to try to get a high profit margin. So this means that the company is healthy. Now, if you have a very, very low profit margin, that's very risky, because if expenses go up, then it's going to mess up your profit margins. So if your business has really thin profit margins, you might want to look into those expenses. Now, the next one is going to be the debt to equity ratio. So this formula basically tells you how much debt a company uses to finance their operations, right? Now, the first part of the equation is going to be the total liabilities. This is going to be what the company owes to everyone else outside of the company, right? So first, you might have things like accounts payable, right? If you have those, whether it's short term or long term. You also have, balances that might be due, interest on the loan, and maybe the principal payments on those loans as well. So you can include the current and long term liabilities, because it's counting all the liabilities. Now, the next part of the equation is going to be the total equity. So this is going to be how much of the company actually belongs to the owners, right? If you know how businesses work, some owners might sell equity, right, to investors. Now, And this equation is looking at how much actually belongs to the owners of the company. How much equity do they have in their own company? Which is pretty much the same thing as how much money does the owner has in the company, right? Sometimes you might have outside investors that might give you money to put into the company, and they own part of the company, so they get equity. Now, how much do you own? How much money did you put in? And how, which is the same thing as how much equity do you have within the company? Now, if you use the formula and you get a high debt to equity ratio, this essentially means that the company is using a lot of debt in order to finance their operations. So if your company is using a lot of debt, that might not be attractive to investors. So if you're trying to get new loans or maybe get new investors, it's more risky for them because you're not issuing stock in order to raise funding for your company. You're just using debt, which is more risky because eventually you got to pay that off. All right, so that is pretty much it, guys. Thank you so much for watching. Now, like I said before, you don't have to memorize these equations, but it's good to understand how they work, right? Because if you're going to be surrounded by these working in business, you have to know where the numbers are coming from. You have to know what the numbers mean, right? And this is going to help you make better decisions. But that is pretty much it. Thank you so much for watching. Make sure to go ahead and hit the subscribe button below if you haven't already, and I'll see you guys on the next one. Peace.